Thank you all for joining today's webinar on U.S. short selling regulation 13F2. We're joined by our colleagues in the New York office. I'm calling in remotely from London. My name is Hap Oakley. I'm Global Head of New Business. We're going to be joined by Sarah Eng of Fund Apps, Patrick Wells of Optima, and Adam Rebeck of Optima as well. Without further ado, I will let them take it away.
So I will start with a brief introduction to 13F2. Many of you are probably a bit familiar with it, but just a little bit of a recap. This rule was introduced, proposed in 2022, finalized in 2023, and will take effect on January 2nd of 2025. It is a short reporting requirement for institutional investment managers that will require them to monitor their positions to determine whether, sorry, let me start from the beginning there. So institutional managers will have to review all of their short positions to determine whether or not the issuers of those positions fall under as reporting company issuers or non-reporting company issuers, because that will determine what threshold to test under. If they are reporting company issuers, they will be subject to one of two prongs. A monthly average of $10 million or more in market value will make them subject to reporting, or a 2.5% shares outstanding threshold. Those are monthly averages. For things that are not deemed reporting company issuers, those fall under a simpler and much lower threshold. That is the 500,000 market value of the short position on any settlement date during that month. So two thresholds, two thresholds for threshold A, and then the simple one for threshold B. And if an institutional manager happens to trigger one of those thresholds, he will be required to file a form show via EDGAR at the end of the month within 14 calendar days. That data will then be aggregated with the filings of all other institutional managers, and the SEC will publish it anonymized after it's received from the various managers. So that's it in a nutshell. I won't get too into the details yet. I'll save some comments for my fellow panelists, but we've gotten some questions about it, which Hap, if you want to introduce those.
And I think we wanted to just, let everyone in the audience know that if you have specific questions that you'd like us to answer, you can feel free to either send them in on the chat in the webinar, or if you're here in the room, obviously interrupt us with your questions. Or you can, I believe, in the webinar, raise your hand, and we'll see that and know that you have a question, and then we can unmute you so you can ask your question directly to us.
So the first question being, how does 13F2 differ from 13F1? Anybody want to take that?
Sure. I mean, that's actually one of the simpler questions, right? So 13F1 is the rule that requires institutional managers to report their holdings on a quarterly basis, right? So if you meet certain thresholds and you hold certain securities designated as 13F eligible for reporting by the SEC, that is a quarterly report that's made within 45 days after the quarter ends. 13F2, as Sarah went through earlier, is a monthly report that needs to be filed within 15 days after month end, based on the thresholds that were listed earlier. And so this is a little bit more onerous for most managers than 13F1, because it's a monthly monitoring, a monthly average that needs to be tracked, and a monthly filing that then needs to be made. And for those of you who've been in the business for a while, who remember the financial crisis in 2008, 2009, there was an emergency order that required funds to report their short sale holdings on a daily basis. So we have a little bit of a relief from what it once was in the monthly reporting, but very similar in terms of tracking. Managers are still going to need to track this on a daily basis and then average it out at month end, and that's where this becomes a little bit tricky.
If I can add one thing too, but one thing I like about 13F1 is that the SEC provides a list of official list of securities in scope. We do not have that with 13F.
Yeah, I think it's safe to assume that everything is in scope based on security class.
Thank you both. Thank you, Adam. Thank you, Sarah. So will the rules apply to foreign investment firms?
I can take that one. So, as Sarah's mentioned, the rule applies to all institutional investment managers who have short positions in equity securities if they meet one of the two thresholds that are laid out by the rule. So it does apply to foreign firms. I think a lot of foreign firms out there who already filed 13F with the SEC are pretty prepared for this, that they've known for a while that this is going to apply for them. I think a lot of the confusion has come maybe for some non-US firms who don't currently file 13F with the SEC. Maybe they might have assumed that this rule wouldn't apply to them since they don't have to file 13F, and now they're coming around to the fact, realizing, oh, this does apply to us. We will have to file if we hit these thresholds. And maybe they're just making, trying to catch up on figuring out how they're going to go about monitoring their thresholds and their positions and seeing if they're going to have to actually make any monthly filings going forward.
Thank you, Patrick. We have a question that came in as well. Will 13F2 information be visible to the public or just the SEC?
So it's a good question, and we hear that a lot from clients. And the way that this rule is structured is that the SEC obviously is going to see all the filings and the firms, managers associated with those filings. But what will be made public is an anonymized, aggregated version of the data that's being supplied to the SEC. And if you look at the timeline on that, that will not start until I believe 90 days after reporting by managers begins. I think the SEC is actually still trying to sort out how they're going to make this reporting. So they've given themselves a little bit more time on that. But what the public will see is an aggregated, anonymized short position by security. It won't detail which managers have reported those short positions. But the concern, we'll talk about this a little bit later in the webinar because we've had some questions around this. The concern is whether people can reverse engineer into that in some way, shape, or form. I don't feel like you could, but I mean, if you know specific strategies, if you know specific firms, then maybe you could, depending on how many managers are reporting in that particular security. So it is a concern that's out there.
Thank you, Adam. A follow-up. Looks like SIFMA filed 13F2 extension requests with SEC on 11/25/24. Any update or response you may be aware of?
I have read that letter. I think there's a meeting this Friday where we might get an update from ICI and all the other industry associations that were involved with that letter. Fingers crossed, we'll see.
Yeah, I mean, I think we're in a very precarious situation right now, right? Because we're coming into year end, things at the SEC basically come to a grinding halt the last 2 weeks of December. Things in the industry get very slow starting right about now. And this rule technically will go into effect in January. So, I think we're in a situation where we have no choice but to prepare for it. Hope for the best that maybe it will get vacated at some point. We don't know. But so far, there hasn't been a lot around this that's been seeping out. I mean, obviously we can talk about, the court case and the oral arguments that took place and we know what everybody's position looks like, but it doesn't seem to have the momentum that the private funds rule had when it was vacated. There's not as much rhetoric going on around this currently.
Thank you, Adam. And then I'm moving on to the next question. Will the rules apply to foreign issuers?
I'll grab this one. So this is where we've gotten a bit of mixed messaging from the SEC around whether or not the rules going to apply to foreign issuers. We'll cover this definitely more when we get into the court case. But as the rule currently stands, foreign issuers are in scope for the rule. And specifically where it is in scope is around threshold B, which Sarah had mentioned before is the non-reporting company threshold. That threshold would trigger if you hit a gross short position of $500,000 at the end of trading of any settlement day during the month. So, whereas threshold A is a average over the course of the month, Threshold B will trigger if you just hit that $500,000 gross position even one time during the month. And so when we get into more to the court case, I think threshold B is kind of the most contentious portion of the rule. And there is hope that potentially it could get stricken out of the rule. But as of now, the foreign issuers would apply under threshold B.
Thank you, Patrick. And does a manager need to report short positions in convertible bonds?
So the short answer to that is yes. If the bond itself converts into an equity security, that is an equity security as defined by the Exchange Act, then the convertible itself is also an equity security.
Okay. Thank you, Sarah. And are ETFs reportable under Form SHO? Is there a look-through obligation?
I'll grab that one as well. This is another short one. ETFs are reportable, but fortunately there is not a look-through obligation. So you're just reporting your short position in the ETF.
Excellent. Next up, we have a question around are futures treated for the purpose, or how are futures treated for the purpose of Rule 13F2?
I could grab this one. So futures are not within scope of Form SHO. I do know there was some confusion at one time about whether securities futures or single stock futures might need to be included in the calculations. But when the SEC released the adopting release, they did talk about, the concerns that maybe some firms might take positions in derivatives to get short exposure, but avoid having to actually file Form SHO. And in that section, they did specifically talk about they're aware that people might initiate short positions in security futures and in order to get around the filing requirement. So, they're specifically highlighting the fact that that firms could initiate short positions in securities futures. And your own filing does give us the assurance that those futures would not be in scope for Form SHO.
Thanks, Patrick. Yes, the next question is, did the SEC publish format for the filed upload?
They did. They published it. Well, they published a draft in October and received some feedback from market participants, including us at FundApps, and published a revised draft in November that addressed some of those concerns. Although we will not get an official spec for Form SHO until I believe December 16th, which is distressingly close to the actual implementation deadline.
Thank you. Does the definition of equity securities cover options, derivatives, positions held on swap and other cash settled positions?
So I can grab this one. So generally, derivatives don't fall under the definition of an equity security, so they're not going to be in scope. Same goes for swap positions, other cash settled positions. I do want to note there one area where you might or you would see the need to include derivatives would be if you are already filing Form SHO when you get to Table 2, which is the net change, daily net change in your position. You would need to include certain derivatives such as options, I believe, securities, secondary transactions would need to be included in that day-over-day calculation of your net change. But they don't need to be included for determining whether or not you do cross either threshold A or threshold B.
Thank you, Patrick. I think that addresses the question regarding that came in for options. When a firm exercises the option only, then it becomes reportable. So the threshold calculation will be done from the day of exercise or the day the option was written.
Yeah, you're not going to actually. Yeah, correct.
Excellent. Thank you. Moving on to the court case.
Yeah, I mean, so as we all know, and we've all been tracking in the industry, this rule is highly contested in the Fifth Circuit. I don't think that any of the arguments are, foreign to anyone at this point. But the general premise that the industry is fighting on is that there are two parallel rules that have been passed by the SEC. One is in relation to securities lending, and the other obviously is the short sale reporting rule. And the industry is arguing that those two rules actually are linked. And the SEC is not disputing that, right? The SEC is affirming the fact that securities lending is directly related to the short sale reporting that's going to be required of managers. But the industry is basically making the assertion that in determining the scope of these rules and the burden of these rules and the costs associated with these rules, that the SEC has not looked at them in a combined fashion, that they've looked at them each in a silo, and they haven't taken the requirements of each of the rules into consideration when putting them forth. And the courts haven't been unsympathetic to that argument. There have been a number of questions that have come from the judge that have led down the path that they feel that the SEC might have acted in that manner. The SEC is not disputing the link between the two rules, but they're also making the assertion that when they did determine the costs and the resources required, that was considered. But this also falls into the same type of arguments that we had around the private funds rule, right? That this is overreach by the SEC, that it's disclosure that should not be required of institutional investors, that it's overly burdensome and costly for registrants and creating a barrier to entry to the business, along with other rules that have been implemented. And so here we are. If we fast forward, this has been going on for I would say almost a year now. We've seen the private funds rule get thrown out. And now, we've also seen the dealer rule get struck down. And so the question becomes, will this follow suit? I don't think we have a great answer for that at this point. Like I said earlier, I think there was a lot more speculation and rhetoric around the private funds rule, a lot more attention on the private funds rule. And there was more momentum in that case, I would say, than I think we're seeing in this. And also, given the change in administration and the timing, we don't know, where this will end up. But here we are coming into the second week of December with an implementation date of January, right? With the first filing due, I think it's February 15th or February 14th. So we really don't have much of a choice but to prepare for it and put the processes in place to get it going.
And if I can follow up to that on the topic of the arguments against,
Sure.
In addition to the link between the lending and the short sale reporting rule, there's also the extraterritoriality component of the short reporting rule. And I kind of glossed over this in the TLDR at the top, but the definition of reporting company issuer, it's very clear. It's any issuer that files reports pursuant to Section 15D of the Securities Exchange Act. Cool. But then non-reporting issuers is everybody else, and everybody else could mean literally every other issuer, and that's where you get to the overreach thing. And is the SEC really saying that if an issuer has an ADR on the New York Stock Exchange and also shares listed in Japan, that institutional managers also need to report their short reporting activity in the foreign jurisdiction? So that's the another controversial aspect.
Yeah, and I think one of the other issues surrounding that particular topic is, the availability of information around those particular holdings, right? These are not holdings where you can necessarily get data from Bloomberg or rely on that data being accurate. So it creates a lot of work for managers to actually make those filings. I think one of the questions that we are asked is like, what are some of the defenses? What's the origin of this rule, right? Where did it come from? And I think at a high level, this kind of goes back to what we've seen from this administration over the past several years at the SEC, which is transparency for all, right? Equal transparency for the public, equal transparency for institutional investors, and kind of leveraging historical market events as a reason why this information should be public. And there hasn't been a great justification as to what historical events would have been solved or wouldn't have transpired if this information had been available when those market events took place. And I would assume that when they talk about historic market events, they're talking about, stock manipulation that they believe took place around things like GameStop and those types of investigations. But the industry has been very vocal about the fact that this could actually have the opposite effect, right? So if you can reverse engineer into any positions and determine what managers or what group of managers or what strategies have the largest short positions or are opening large short positions, there could be retaliation against those managers, right? And short squeezes that take place as a result of that. So that's been one of the arguments that the industry has put forward, that the court seems to be receptive to.
But with anonymized data, that's still possible.
That's the big question, and I don't think we really know, because the SEC, although they've said anonymized data, aggregated data, we don't know exactly what that's going to look like because they haven't given us any guidance on that. And so that's one of the concerns that we hear. And the other concern that we hear is, obviously, as with any regulatory filing, this information is going to be reported with names to the SEC. That data is going to be maintained somewhere within the commission, within the government. And we know that the systems of the SEC have been, in the past, vulnerable to hacks and whatever else. And, could somebody actually get into that database and somehow publicize these things? Those are the arguments that the industry is formulating against it.
Can't leak information you don't have.
Thanks for that, Adam. The SEC repeatedly confirmed the rule's extraterritorial effect in the formal rule making process and in the public address. Why do you think they changed track in the appellate brief?
I'll grab this one because the extraterritoriality thing is my favorite topic. Honestly, because they don't really have a lot of justification to stand on in terms of the extraterritoriality bit. I mean, they're like Morrison versus National Australia Bank, very clearly determined that U.S. securities law only applies within the jurisdiction of the United States. Basically, you only have jurisdiction where you have jurisdiction. Very circular, but it's for a U.S. agency to say, okay, we need reporting on securities that have no nexus to the U.S. is really, really difficult to justify. So in that brief, the SEC backing off of that point, I think was honestly really their only option.
And again, this goes back to the overreach argument, and the lack of jurisdiction, which not only came up in relation to this rule, but have come up in relation to a number of proposed rules, over the past year or two, that the SEC is just going above and beyond what their jurisdiction is by requiring managers to provide, certain disclosures.
And it seems like that, by realizing that overreach, they're pulling back in an effort to make sure that the whole rule doesn't get tossed out specifically due to that, the extraterritoriality aspect of threshold fee.
Yeah, and I think that's a really good point, because if you look at the private funds rule, the way that played out, the SEC held very firm on all of the components of that rule, even though the industry probably would have been amenable to a revised rule that took out certain components, and they probably would have been able to get some portion of it passed if that happened. So maybe, and this is totally speculation, but maybe given that experience, they realize that they may need to pull back on certain aspects of this rule in order to get the lion's share of it, implemented and not struck down by the court.
Actually, a good segue to the next question.
Yes. Who would like to take this one?
I mean, sure. From what's out there, I mean, I don't think there's any reason why threshold B couldn't be separable, just because it's completely separate from threshold A. It's completely different criteria that you have to hit. It applies to completely different issuers than that apply to threshold A. When threshold A is very clear, as Sarah mentioned earlier, who it applies to the issuers who are in the U.S. who are filing reports with the SEC. Threshold B is everybody else. So there's no reason that you couldn't remove threshold B and still maintain what the lion's share of the rule is, which would be threshold A. So especially if they're backing off of there are comments that there is that extraterritoriality portion to the rule. You could very easily remove threshold E and just keep threshold A.
Are there any, I mean, this is a question for both of you, and I'm not actually sure of the answer, but are there any situations where A and B could be intertwined, where you would have to actually unwind it if it were to be separated?
I'm not aware of it just because it's threshold A is very specific with specific issuers, and then threshold B is just the bucket of everybody else.
Right.
I think it's more likely that you have to refine the definition of what is in scope for threshold.
Right.
Like use your words. What do you really intend to capture here?
Do you think the comments made by the SEC about extraterritorial territoriality in their brief will have any legal effect?
In terms of whether so I'll take this assuming that the question asker is thinking about, okay, if I choose to just not report my foreign issuers on January 2nd, will I be okay? That's kind of a firm by firm decision. If you want to be strictly, if you want to be pedantic about it, which as a former compliance officer, I often am, the regulation is the final rule is what it is, and that is what we have to comply with on January 2nd, regardless of all of the other noise going on. But it's fair to say it. I don't want to tread into the area of legal advice. But gentlemen here.
I tend to agree. I think, I think we just have to take whatever the final result is, and that's what we have to work with until we're told otherwise. I don't think these types of rules leave a lot of room for interpretation. They're pretty black and white and fairly clear in most cases. And look, we're all going to find a gray area at some point, and then a call is going to be made, and then it determines, best practices going forward. But, I think it will be pretty black and white.
Thank you. And do you think the SEC's comments made in the appellate brief will add to the argument?
They did a great job of defending their position. I think that a lot of comments that they made, I don't know that they added to the argument that the industry is making, but they certainly didn't disprove it, from what I've seen. And I think that that's important, moving forward in determining, what the courts are going to do here. I think the industry's made some pretty solid arguments that, that the SEC has not necessarily acted in the manner that they should in terms of rulemaking, that there is overreach, that there is lack of jurisdiction. I don't think anything the SEC said in their rebuttal disproved any of that.
And what do you expect the court's opinion to be? How would that opinion affect 13F2?
I mean, that's the big question, right? I'm sure somebody has wagers out on this somewhere, somehow. I think it's 50-50 at this point. I don't think we can really predict what's going to happen in the coming weeks. I think that there's a possibility that the courts will strike it down, but there's also a possibility that they may look at this and say, you know what, this one doesn't matter as much, right? We're not as concerned. It doesn't have the ripple effect through the industry that the private funds rule had. And I think that's kind of been the view from the beginning on this, is that, there's valid arguments, but it doesn't have this chilling effect on the industry that the private funds rule was anticipated to have. Are we going to give it as much weight as that? But I mean, the options of what could happen from here are either the court says, we're not doing anything, we're leaving the rule as is, in which case we're all going to have to adhere to exactly what was passed and written. The court can take the rule apart. They can say, that certain aspects of it are going to get tossed and certain aspects will remain, or they can strike the whole rule down. And those are the three options. And I think the path forward from each of them is pretty clear, right? In the first scenario, this is what we have and this is what we have to do. In the second scenario, we might need to tailor it slightly to accommodate revisions that might be made to the rule. And in the third scenario, then, we have nothing. But even, I would say at this point, even if we want to place our wagers on the fact that they're going to strike this rule down, I personally don't feel like that's going to happen in time to prevent implementing something in January. And we all know how this works, right? When a rule takes effect, there are SEC examinations of managers that are taking place. The questions were already being asked of managers as to how they are going to approach this rule. That's going to very quickly in the first week of January turn to where are your policies and procedures? What's your process? Demonstrate to us how you're going to be in compliance with this rule. And even if that's a short period of time, before we get some type of ruling out of the courts, it still technically is a rule violation if you don't have something in place during that period. So, our advice to our clients is this is the time to prepare for this and put in place, process and policy around it.
Terrific. Thank you, Adam. And now that we've heard the oral argument on 7th of October, does that reveal anything further?
From what I recall, October 7th seems so long ago. That was about the securities lending correlation, and they weren't trying to defend the extraterritoriality bit very much. So that, reading the tea leaves, that gives me makes me suspect that threshold B will be severed. But that's the only hints I got from that.
Yeah, I think one of the things that came up in the October 7th arguments that was interesting that the industry raised is that this would have a chilling effect on things like price discovery and those types of trading scenarios. And I think there were some decent arguments around that, although I don't think it was the focus. It was just something that was added in there by one of the industry groups that I thought, that was new in their argument and made sense to some extent.
Next up, when do you expect the court's opinion to be published? You expect a remand period?
It's an interesting question because with the private funds rule, there was a date that was requested for the courts to make a ruling by a specific date, and I have not heard that come up in the context of this litigation. So I don't think we have any time frame. This could go on for a while.
Okay. Noted. Are there any recent cases that give us some context around what might happen?
I think the closest parallel would be the private funds rule. But like I said, it was a much broader, much more overreaching piece of legislation that had a lot more steam behind it in terms of fighting it and had a much broader effect on the industry. So although similar situation, I think different circumstances, but I think that would be the closest parallel. Maybe the dealer rule to some extent, that was highly contested in the industry and had a narrower audience.
Thanks for that, Adam. Moving on to implementation. How could the timing of the judgment affect what actions investment managers have to take to comply or to prepare for compliance?
I can grab this one. So, as we've just discussed, we really don't have any clear idea on when a ruling on the court case might come. I think it's probably safe just to assume it will be after the January 2nd compliance date. So managers really need to proceed with the assumption that they need to be prepared for the rule as it currently exists. So, what we've been telling clients is you really need to make sure that you have solutions in place for both getting the data you need to be able to make sure that you're able to determine whether threshold A or threshold B are being crossed. And then once you have that data and you're able to make those determinations, you also need to make sure you have a technological solution in place to take that data and get it into an XML version file that you're able to file with EDGAR. So you really need to proceed, assuming that the dates are going to remain the same and the rules going to remain exactly as
it's currently. Yeah, I mean, I think it's really important for firms to look at this and really develop a process, right? I mean, there's a lot of moving parts when it comes to this. And like I referenced earlier, if any of you have been in the industry for a while and had to do this on a daily basis back in 2008, 2009 during the financial crisis, it was incredibly difficult to pull all the correct data. And I would say, 70% of the filings that were made were probably incorrect, but people pushed them through because they had no choice. There's a lot more runway with this, both in terms of preparation now before it goes into effect and preparation of the filings themselves on a monthly basis versus daily. But similar to other regulatory filings that we have to make, it starts with an internal process, right? Who holds the data? Who's responsible for confirming the data? Who's going to approve the data? What systems are you going to use to help you flag these required reports? And how are you going to verify, right? Like, what's the process for verification? Because as we all know, there are going to be false positives, and no one's going to be able to verify that except the people in the firm, that know their positions better than, their technology provider or their compliance consultant. So I really think there needs to be a team, assembled, and the members of that team probably come from various departments, right? It's portfolio management, it's operations and accounting, and it's legal and compliance internally that really have to work together to get it across the finish line.
And and you mentioned there's a lot of runway for this. It's absolutely true. It was passed in October 2023, but there are still a lot of unanswered questions. Yeah. Which I think one of our participants online that had asked about the ICI letter, it lists a bunch of still gray areas about reporting and highlights the concern that as with the earlier short reporting. Firms are going to have to use their own judgment about what's in scope and how to calculate things, and you're going to end up with inconsistent reporting. And how is that useful to anyone? So it's, again, firms do need to, assess their own risk and be ready for the rule as it's written at the stance of January.
Thank you, Sarah. We've got two additional questions that have come in. The first is XML upload the only way currently the SEC expects investment managers to submit form, or would there be a manual way to do this?
Both. There will be a web portal available on Edgar. So like a fill-in, a cut and paste web fillable form. But it only accepts up to 100 positions for table 1, which is where you report your month-end positions. The XML option will accept up to 1,000. So that's
okay. And the follow-up question separately was just to confirm, when does the security become reportable? When the thresholds are met on an average basis over the month, or if at any time of the month you go over the threshold?
That's the issuer.
Threshold you're talking about.
Yeah. So threshold A, it's the monthly average for the 10 million USD or 2.5% shares outstanding. And that's a monthly average. It's not a single day's activity. Threshold B, which is the 500,000, that is any day during the reporting month.
For non-reporting companies.
For non-reporting company issuers. So even if you close out that position by the end of the month, you're gonna report a 0 gross position, and then table 2 you're gonna show your activity.
Yeah, I think it's just also important to emphasize, in reporting securities, they do need to be tracked on a daily basis, right? Because in order to get to that average, you need to know on what day you crossed, what your position was, and then how that position has changed over the course of the remainder of that month in order to get to that average. So even though we're looking at it on a monthly average, we're really still looking at it on a daily basis in order to get there.
Yeah.
And so the behind the scenes tracking mechanism needs to be in place to identify it on a daily basis and to confirm it, I would say, on a daily basis, right? Because if that data is wrong on one of those days, it's going to throw off the entire average for the month. And if you first find that out after the close of the month, it's going to be really difficult to go back and reconstruct.
Also in table 2, you're going to need to look at it on a daily basis. Table 2 is just reporting your net daily change in the position. So you really have to be looking at this every single day.
Yeah, and that gets into the data questions. I think there's a question on that. Oh,
Thank you. Next up, do you think firms are ready for the compliance date on the 2nd of January?
I think it depends on the firm right now. There are a lot of firms that have done a lot of work on this and have put in place, the right vendors and the right process. But I would say, there's probably a good 30-40% of the industry that's going to be subject to reporting that is first starting to look at this now, because a lot of people have been, hanging their hats on the fact that it's going to get thrown out. And now as we get really close to that deadline and it hasn't been thrown out, people are kind of scurrying to sort out how they're going to address this. So I think in the past couple of weeks, we've really seen a lot of momentum around this across the board. But I don't think the majority of the industry is fully ready to go live on this.
Perfect. What?
We've actually at FundX had some initial rules that we rolled out to our clients in June to have them start testing this and getting used to the daily monitoring. So not to brag, but certain clients are ready.
Yeah, I mean, I think mentioning testing, this is really important. Like, if at all possible, to test it before January, I think people should. Because what you will find is when you start to test the rules, when you start to test the process, you'll find flaws. And you do need to account for that in the runway leading up to implementation.
Thank you. We have another question from the audience. If a position is entered, for example, on the last settlement day of the month, then too, we need to divide the dollar value position by all settlement days in the month, ? If yes, this will water down the exposure. For example, a 50 million position is entered on the last day of the month and has 22 settlement days, then 50 million divided by 22 brings it under the threshold for A. So does this make the security not reportable?
Correct. That would be based upon the average for each settlement day, you would not have to report that position for that one.
Thank you, Patrick. And what sort of data and technology will be required for 13F2 and Form Show?
Well, Adam alluded to this a little bit already, but with the daily monitoring, especially for the shares outstanding, you're going to have accurate shares outstanding numbers for each of those days during the month in order to calculate your monthly average of percent shares outstanding. And that could get very tricky with things like stock splits, any kind of corporate action, because to that point, it's garbage in, garbage out. If one of those values is wrong and you're using that to calculate an average, you could risk under or over estimating your actual percentage ownership for the month. The other data challenge is just identifying what is a reporting company issuer. So who is in scope for threshold A and who is in scope for threshold B. We talked a little bit about that earlier. The way that threshold A is very clear cut. It's equities that are registered under the under Section 12 or issuers that have 15 reporting. But identifying what issuers are required to file 15D reports is not as easy as the SEC seems to think it is. I don't know if we want to get into solutions. Well, we'll talk about that a bit later. But identifying threshold A issuers has become a new niche industry within data providers. And then the third and probably most infuriating data question is the fact that all of this is settlement date based. So I don't know about you, but most of my accounting book of records, my OMS, everything is trade date reporting, and this is asking for settlement date, which is just an added layer on top of the whole thing. And then having to create that XML. I could go on with the data challenges, but I will leave it there.
We've got a few questions left in the slides here, and then we'll open it up to any Q&A, being mindful of time. How will you deal with any questions on legal opinion as we navigate changes to 13F2?
I kind of addressed this earlier, where you've got the rule as it stands, and we have a lot of open questions. We have a court case that hasn't had a final ruling. We've got a request from ICI to extend the date. Neither of those things have happened, have been resolved yet. So, just using the final rule adjourn.
Like I said before, I don't know that there's a lot of room for interpretation right now. Certainly as we work through this and, as this goes live and we have, unique situations, there's going to be, situations where, you're going to want to get legal advice or legal opinion on something and, that will form how to handle those situations going forward. But as it stands right now, I think we have what's in black and white and that's about it. There's not a lot of opinion or subjectivity around it at this point.
What we don't have, which I wish we had, is a set of FAQs from the ex, which would help.
Exactly. And that's usually where this all gets fleshed out, right? You can hang your hat on the response and the guidance coming directly from the commission, but there is none because of the court case.
And how are fund ops and Optima ensuring they will be ready to implement by compliance date?
Tease this a little bit from the fund ops perspective, but as I mentioned earlier, we do have rules that are in our clients' environments that they can use and test and throw their data against it and see what happens. We've also that XML spec that I referenced earlier, that we took a very close look at that when it came out in October and had some complaints about it. The revised version came out in November, so we are working on drafting the XML so that our clients will have it on Valentine's Day next year if they need it. And we've also started a threshold data service to help clients identify threshold day issuers based on an analysis of public EDGAR filings. So that is what we're doing.
Yeah, and on the Optima side, we've done a lot of work on this. We have an internal team that has been monitoring the situation and providing guidance to our clients. We're helping clients to build out their process and their policies around this, and working very closely with vendors like fund apps, so that we can have a coordinated effort around this with our clients. There's two sides to this. There's a technology component, and then there's the regulatory compliance internal component. And so we've worked very closely with fund apps, on these types of scenarios before, European short sale reporting, where we have dedicated teams that work on that with fund apps, and now in the US to address this similarly.
Right. And how do Optima and fund apps work together? Funny question. Do we want to jump into this one? Are there any other major cases that have occurred recently, or do you want to open it up to questions? Is this something you want to address?
Talked about that. Just the really short answer is we've seen the private funds rule case play out. We've now seen the dealer rule case play out. Those are the comps on what we're looking at here.
Great. Will the return of the Trump administration, what will the return of the Trump administration mean for U.S. regulatory environment?
I could have a completely separate webinar on this and go on for half a day at least. Look, I think at a very high level, and not to eat up the time that we have left, because I do want to make sure we have time for people's questions. We're going to be looking at a very different administration. I think we're going to be looking at an administration that's more closely aligned with what we saw under Jay Clayton. We know Gary Gensler is out. He's already handed in his resignation. There will be an appointment made by Trump. That appointment, will have a very different opinion of what the SEC's role is in regulating this industry. And if history tells us anything, the priorities will likely shift over the course of the next year. It does take a little bit of time to filter its way through the commission. It will likely shift to, protecting retail investors, looking more at wealth managers and fraud against, the individuals versus the focus on private funds, and from an enforcement perspective, that's where you really see that play out. Exams are exams, deficiencies are deficiencies, and those are always going to be noted. That's what the division of exams is there for, regardless of who's running it. But the big question is, what becomes the enforcement priorities? What are the big cases? Will they still be things, that are books and records related, or archiving of electronic communications where it's low-hanging fruit to make headlines, or will we go back to an enforcement regime that's focused on protecting the end investor, protecting the retail investor, where fraud becomes priority number one, and the smaller cases, the broken windows policy goes away. And I think it's a safe bet that that's where we're headed. Not to say that funds don't need to worry about being in the crosshairs of the SEC, because they always will be. But there will be a tone change, and I don't think we'll be dealing with such an aggressive commission going forward. And, there's a number of names that have been thrown around as potential future chairs of the SEC, and most of them are, historically much more industry-friendly people than we've had under this administration. And what will happen is each of the division heads of the SEC will likely turn over. Those are appointed positions. And then within each division, the question becomes whether or not the number 2 or the number 3 will step up to run that division, or will someone be appointed from outside the commission? If there are appointments from outside the commission, it's usually much more industry friendly. So I think that's what we're all hoping for.
A follow-up question about sales. I could ask one question. So in regards to 13F2, is there any language about penalties or people not file for the first time on Valentine's Day, or like what's going to happen? And if not, historically, what happens with these like kind of new regulations?
Yeah, I haven't seen any specific language about penalties, but we all know that regulatory filings are low-hanging fruit for the SEC when it comes to both deficiencies and direct rule violations, which lead to enforcement actions. So normally what we see when a new rule is implemented is there's a sweep, right? And so a few months, usually after it's implemented, there's an industry sweep. We're seeing it with the T+1 rules now. We have a number of clients that have received that sweep. We saw it with the new marketing rule when that was passed, and that continues. So I would expect that there will be a sweep focused on the filings, and you will start to see enforcement actions and settlements for those firms that don't comply.
Would you expect to see that in like the early days though of the first filings? Or
I think so. If you ask me that question under the current administration, I would say yes. I would say they are going to, make a name for themselves by saying, we gave you a year to get this implemented. If you didn't do it, now we're going to put your name in the press. Depending on a new administration, there might be a little bit of a different approach, and it might not be quite as aggressive.
enforcement priorities change with each.
Yeah, and it's funny you say that, because they put out the Division of Exams puts out their priorities, which usually closely align with the enforcement priorities on an annual basis. But usually by the time that they put those out, they've moved on to other topics. So it's really hard to gauge where they're at currently.
Thank you. Well, another question. This one's for Sarah. Does Fund Apps provide a service where they can consume investment managers' reportable data, create an XML for the IM to upload on a monthly basis?
Yes. Our clients, so the 13F2 monitoring is included as part of our shareholding disclosure package. So those rules will, you upload your data on a daily basis, we evaluate your positions, and then we'll generate the XML if you do have a reporting obligation at the end of the month. Dave, anything to add?
Yeah, and the ability to file could either be done directly through a partner like Optima or through the Fund Apps portal. So making that obviously as easy for your custom workflows or your processes we can.
Thank you. Opening it up the last minute or so, we're just about out of time to see if there are any additional questions.
Questions all day. So one thing that Patrick said, which was interesting, was that swaps are not actually in scope. Can we see a change in everyone just trading everything on swap, and while the prime brokers being very, very busy? Is that anything like potentially clients are talking about?
In theory, you could. I mean, I think that's some solution for some foreign managers who don't trade a ton of like U.S. securities. They don't short a ton. It might be, it might seem easier for them just to trade it on swap, just to make sure that they never trigger these thresholds. But if you're trading a lot, maybe it's not something that you're looking to do. So I mean, it's definitely out there as an option. I guess it's gonna be, case by case. Each manager has to determine if that's something they would do on their own.
Yeah, and we get those types of questions all the time around various rules. Reg M is one of them as well. I think the underlying premise is you can't do indirectly what you're not permitted to do directly. So if you are creating some strategy to trade on swap to avoid regulatory reporting, I'd be very leery of that because it's something that the SEC likely will catch on to and likely look at over time. We've seen people who've tried to create synthetic short positions to avoid Reg M requirements. That's been uncovered by the SEC in a number of ways when they look at trading. And I think, we have some pretty smart people at the SEC that are behind the scenes that can identify trends, whether it's by firm or by industry. So I'd be careful about, specifically creating a strategy to avoid the rule or the reporting.
Yeah, that's reminding me a lot of one of my favorite parts of the 13D rule, which is cash settled derivatives. Okay, they're not in scope unless you're trading them to avoid reporting, in which case totally report them.
Right.
Well, thank you, everyone. We're just about out of time. For those that are still on, we will be sending you the recorded copy of this. And for those attending in the room, thank you. I'm going to log off, but feel free to stick around and chat with our colleagues. Special thanks to Sarah for joining us today. Patrick and Adam Rebeck, much appreciated. I hope everyone found this session to be very valuable. Cheers. Have a good day.